Episode 528, Trading Justice Podcast. Matt, I have been in a pissy mood for days. My energy is low. But before we get into some market relevant things, and before I ask you how you're doing, because I talked to you all weekend, so I know how you're doing, I want to talk about why I'm shorting McDonald's coming this week. One, first of all, is priced like some 8 billion PE growth stock, and somehow that, but more importantly, they switch, because you know how I love McDonald's Cokes.
You do. I've lost that debate a lot.
They have switched from paper cups to these stupid plastic cups. And as a Coke connoisseur, you have bougie wine connoisseurs who say, oh, yes, that has a minty, frothy, whatever. Coke tastes better in a paper cup out of McDonald's, and it don't taste nearly as good out of this crappy plastic cup.
I thought we were going
to see what I can do.
McDonald's, what's going on here?
Put calendar spread on.
I'll tell you what,
MCD.
McDonald's, I don't know if I would start with a short on McDonald's this week. It's got a pretty good trend going, a little bit overextended, a little bit overvalued on an intermediate perspective, but I don't know if I'd be shorting McDonald's against that general trend right now.
Yeah, probably not the best idea on a technical basis, but fundamentally,
principles matter here. Principles matter.
This is a decrease in the quality of my life.
Okay.
And I don't even have some old paper cups. See, I need to find an old paper cup, and so I can pour the drink in and have it in the paper cup.
This reminds me a lot of Michael Scott on an Office episode at one point, but we can debate that at a later date.
All right,
I did not put complaining about McDonald's at the top.
Oh, I didn't. I podcast bombed you on that. You know, we talk about what we're going to talk about. I podcast bombed you.
We were talking about,
let's ready to go.
We were talking earnings. We were talking about economic situations coming up. We were talking about what we learned out of retail earnings this week. And I was not prepared for the McDonald's paper cup protest. I wasn't prepared for that.
All right. In this podcast, other than complaining about McDonald's paper cups, we're going to talk about reasons the markets might go up, do nothing, and go down. Tie in all of the things going on in the market, tie in debt ceiling, tie in earnings, tie in this, tie in that. But, I'm going to start optimistically, Matt. I'm seeing a lot of stats like the one I'm about to give you out there from bulls. Got a good old-fashioned technical breakouts going in major markets. NASDAQ made a new 52-week high. And the previous times it made a 52-week high after 6 months without one, 14 out of 14 on performance in the next year, right? A lot of stats like that. That is just one of many that bulls are like, third-year presidential cycle, this, that, right? I feel like I'm back in my sports betting days with all this team hasn't covered at home in 16 games. What do you think they're going to do this time type stuff?
You bet that trend usually.
But, from the technicals, right? Market sentiments, technicals, fundamentals, technicals surely are in favor. Talk about those technicals.
Yeah, technically right now the market S&P kind of hovering right underneath that 4,200 breakout. Tested the breakout this week, actually closed above 4,200 on Thursday, hovered above that level right on Friday, came back underneath that 4,200 breakout zone. So you're right there on that weekly, daily breakout of 4,200 right now. And it's one of those charts in the market that really just stands out. It's one of those charts that, like, you look at that on a weekly chart and you're like, oh my goodness, multiple time frame analysis looks pretty good above that resistance channel as well. And so it's hard to throw any cold water, for example, on a marketplace that looks like this right now when you're talking about that potential breakout. And then when you look at it from a multiple time frame perspective, once again, look at it on a daily chart, you look on a weekly chart, you look at it on a monthly chart, it all points to the same probability of a potential breakout right here. And so I don't want to say anything negative about the technical condition, because the technical condition of the market is actually really, really clean from a macro perspective. When you look at the NASDAQ's outperforming. When you look at the S&P 500, it's very, very clean. But underneath the surface, I think there is some concern.
Yeah, we'll get to that in a second. You say you're negative Nellies.
Oh, listen, I might have
and by the way, my name is Mark, and I'm bearish. And I'm unapologetic. In fact, I now have, because I see, man, and this is one of the things that also could. So technicals, I mean, it is hard to not put technicals in the bulls camp. I mean, give me that NASDAQ chart.
It's impossible.
You
It's
can't
impossible.
make the case. Higher lows. That thing, if you turned off my head and ignore everything I know, that thing is one of the most beautiful technical patterns coming off a reversal bottom it's almost textbook.
It's pure. It's pure.
It is just beautiful.
The NASDAQ has been extremely consistent all year long. Even in bouts of volatility, the NASDAQ has really held support levels. It's the number one theme that is driving right now in the market is the big cap tech areas of the market. Apple, Microsoft, NVIDIA really kind of leading the charge in the tech space. You have Google, Amazon kind of coming on strong and not to mention, what Netflix last week. Meta's been a leader all year long in the comm space, but now you have Amazon really playing some pretty decent catch up from a technical perspective against, say, Google, Microsoft, and Amazon and Apple. And so it's been a top heavy market.
And Tesla developing, it's not as pretty of a chart as other things, but when you look at those like brand name things, right? This thing could have easily collapsed like it did. And it's not ugly.
Especially after this earnings season. They had a negative response to their earnings. It started fading underneath support. But then over the course of the last month, it's recovered very nicely to the point where you're looking at a potential breakout in Tesla here. But my general point is, when you're looking at the NASDAQ, when you're looking at the S&P 500, it's really reflecting the strength of the big cap areas of the market. It's reflecting the Apples of the world, i.e. technology and Microsoft. It's reflecting, because of the weighted indexes, it's reflecting Amazon and to a lesser extent Tesla right now, but over the course of the last, say, 3-4 months, man, Tesla's been a really, really good performer from the beginning of the year so far. And so you have leadership from the big areas of these markets. Again, Microsoft, Apple in tech, and NVIDIA, Amazon, and a little to a certain extent, Tesla in discretionary. And in comms, you have Google and you have Meta. All of these big cap stocks have been providing a lot of leadership recently. And these areas of the market have just done so well. When you're looking at it from a sector perspective and you're saying, okay, technology breakout looks really, really good right now. When you're looking at discretionary is one of those areas I've been talking about that can play catch up on the backs of Amazon. We're starting to see that play out. And then communications has just been right there with technology all year long from a consistency perspective outside of one short-term trend. You've had real good leadership provided in these areas, and these areas are what's propelling the S&P 500 into the 4,200 zone. It's what's been carrying the market all year long. There's no doubt about that. The ultimate question is, how far can these companies carry until they start to get a little bit weighted, until they get a little bit too many participants on those broad shoulders? And don't get me wrong, they have massively broad shoulders. They can carry a lot, and they can carry for a long time. In my estimation, they carried the entire market from 2013 through 2017. And so they can carry, but can they carry in the face of what's happening from a cyclical perspective right now? That's my concern, Mark. And so I don't want to, come across as I'm bearish. I'm not. I'm in that.
Hello, your name's Matt, and you're not bearish.
I'm not bearish. I'm not, but I am a little bit concerned specifically this week on the breakout. And
we will get to your. Listen, I have this dialed in on a linear thing. We will get to that and your negativity and all your hatred. You hate America. Why do you hate America so much?
Because Apple's overextended, coming in near to a 52-week high, and I'm not sure it's going to.
All right, so
level, but we can have that conversation.
Unless you have been not listening to the podcast or the halftime report for the last 3-4 months, we know what's driving this, right? It's a combination of, at one point, flight to safety, at the next point, AI, has become all the rage, right? All the rage. And got a little, listen, I'm going to call it, got a little baby bubble brewing here in big cap stock, and the one thing if you've been around the market as long as we have, you do not try to guess when any speculative run ends.
Baby bubble can get bigger.
You sure don't do it when it's involved with the generals. Like when it was SPACs and this and that, you knew that there was some limit. It was pretty crazy, right? Where it went to.
Listen, you knew marijuana was going to last a few months before it catered. You knew it was. You knew this a few years ago when every company was out there trying to wrap, some type of crypto over their logo or crypto over their perspectives. You knew that fad would not last because you could just go to the crypto areas of the market. AI, my thing with AI lately is it's real and it's really important. And it's not one of those things that just has a short-term impact on the market. We're talking about major technical evolution here, Mark. And so, no, you're seeing the birth of a movement here. And so, no, I don't think you want to go against the AI movement. Number one, it doesn't mean that there isn't a little bit of a bubble happening, but what are you going to do? Fight against Amazon now?
And that's the thing.
Apple, fight against Google, fight against Meta, fight against all these leadership, NVIDIA. Yeah. That's impossible to do right now.
No, and FOMO is a real thing in the market. Nobody wants to get left behind because, once again, whether you're a new trader just coming into the game or you've been around, well, if you've been around, you've been left behind on something or another multiple times, right? You hate the feeling when it happens on the big, when it happens on the bigs and the bads, right? Those Microsofts and that, it's a real thing of FOMO that develops. You add to that a theme that actually nobody can really scoff at, right? Although I do have a podcast that I want to do coming up in coming weeks, why AI might be the most bearish thing to ever happen
by the end of the world.
Yeah. But that is
a subject. The world would be the most bearish thing that ever occurred.
No, it is not Skynet destroying us.
I'm just saying, like, you can paint some negative things. I think we just need to have an open and honest conversation on exactly what AI is, what are the positives, and what can those positives lead to, which there are immense positives with the AI story. There's very, very good things. Efficiency is one of those. But also there's a healthy dose of concern. And you saw that on the Hill this week with certain congressional hearings on AI. The leaders of AI are calling for regulation here because of, there's a lot of opportunity, but there's also things that are concerning with the AI movement. And I think we just need to have a conversation for our community, because I know you've done a lot of research into the AI situation. I have as well. There's some pros, there's some cons. I think we just have one of those conversations where we lay out the pros and the cons of AI, and the pros are going to be mostly market related and the cons could be a
societal. I think it's one of those things, and we'll talk about it in a future podcast because it's a big subject.
It is.
I think it's one of those things Donald Trump and Elizabeth Warren can see eye to eye on
the regulatory perspective. I think that's important.
And so, but needless to say, here in the now, right, we got a technical situation that is very constructive, driven by leaderships, the very names that just ooze FOMO from a trader and investor soul. You got, the situation for a real spark up, especially if you can get cyclicals, because obviously the AI stocks, the big caps, they can keep chugging on, right? Eventually a topping pattern will emerge. Don't try to figure out where that is. Find your trades in that area until that point. Would you agree with that? Keep trading it until it gives out.
Oh, from a keep trading the tech comms discretionary.
Yeah.
Oh, yeah. I think
you just keep trading it till.
From a trader's perspective, I think that's where you're really kind of focused.
Yeah, because it could go on for 18 months. Well, like you don't know.
Right? Again, I don't think you ever question the trend. I think you always trade in the direction of the overwhelming trend. And when you're looking at the NASDAQ,
unless you're McDonald's.
Unless you're McDonald's, according to Coach Mark. But when you're looking at the NASDAQ, you have breakout with momentum. No, my concern this week on the 4,200 breakout is not short the NASDAQ. It's the NASDAQ's overextended on the breakout. And I could see some profit taking scenarios this week that we can talk about. And so, no, you don't want to go against the momentum that is occurring here. You want to jump on that bandwagon. You just want to do it in a scenario where you're not the last to jump on the bandwagon, because if you're the last to jump on the bandwagon, Mark, you're probably going to hit the ground. And so that's kind of my concern coming into this week, is just that the S&P is hovering on that breakout. We know the leadership of the market has propelled the S&P into that 4,200 zone, but the leadership of the market is the areas of the market that are also overextended right now. Circa Apple, for example, you've had really, really good trends. And I want to argue that Apple's overextended. No. I would argue that Apple is overextended from a longer term perspective, coming into major resistance. When you look at Google out there talking about some of these stocks that have provided leadership, I don't think there's a technician in the world that wouldn't call Google overextended right now and ask for a little bit of patience as we navigate this overextended technical move, because Google's been on fire recently. It's had a wonderful, beautiful breakout, but that breakout has went up for a week and a half straight. It's been powered by algorithms and AI move and the bandwagon traders jumping onto it. But now it does feel extremely crowded at the top. You're seeing some slowing momentum in Google. You probably expect a little bit of profit taking after a run that you've had in Google. And so you're just a little bit overextended on some of these. And when you look at Amazon here, Amazon from pivot to pivot has moved over 10% right now. It's moved over 12, 13% from pivot to pivot. I don't care what the stock is. If it's moved 13% in a week and a half, and you're starting to see a little bit of shifting volatility at the top end of that trend, I'm going to call for an overextended situation there as well. And then when you come over to some of the other leadership like Netflix gapped and ran this week. It was by the way, we nailed this trade. And
yeah, you and Emily got this one good on Tuesday.
Nailed this trade on Tuesday. It was just pristine. But now that trade, this is the thing with trading. If you're late to the party, yeah, you're going to be working against resistance instead of support. So it's not that I'm looking at the general market condition and saying, hey, listen, this 4,200 zone, it just doesn't have legs and it's not going to break out. That's not my opinion. I feel like the NASDAQ's in a nice little bullish uptrend. S&P could join that hit parade. I just think this week specifically, I think we're still going to be, and I could be blatantly wrong on this, Mark, but my concern is this come next Sunday, when you and I are also talking on the podcast, I think we might be talking about the 4,200 breakout yet again. And either one, it's from a technical perspective of a snapback retracement after a breakout, or two, it's just hovering right underneath that breakout. I think at that point, you probably have a little bit more confidence going into the 4,200 breakout that it could have a little bit more legs after a week of digesting some of these areas of the market that have provided tremendous leadership for the market. Without the leadership of Apple, Google, Microsoft, NVIDIA, another stock completely overextended right now, has a massively important earnings report on deck this week that could, and NVIDIA needs to inspire after a bullish move like NVIDIA's had over the course of the last 2-3 months. It's completely overextended coming into its earnings report. And Mark, I talk about expectations on earnings all the time. When a company is at the low point in their cycle, those expectations get a little bit lower, easier to overcome those low expectations, versus a company like NVIDIA that is a leader of the market right now, that has just been that's been more bullish than Apple, more bullish than Google, more bullish than Amazon, more bullish than almost any stock out there in the market this year. It's had a fantastic year so far. You better produce on earnings this week. You better produce on earnings this week. And I could see a lot of scenarios, Mark, with NVIDIA where overextended situations, institutions, hedge funds using the earnings to lock in some of these gains along the way. I could see some scenarios like that. So again,
especially when, let's call a spade a spade. This is the closest thing we've seen to SPAC mania since early 2021. The valuation is basically pricing in utopia, like
specifically on NVIDIA.
NVIDIA specifically.
Yeah,
NVIDIA specifically.
We can make slight overvalued arguments on Apple, Microsoft, and Google. Would you agree with that?
Yeah, but it's not even worth discussing, to be honest.
Because they're not, they kind of match on like,
because they're not absurd, right?
You can still make an argument that Meta is still undervalued versus what it's been doing. You can make an argument on Google for that exact same reason. But even Apple and Microsoft, I'm not sure you're paying any higher premium today than you were 5-7 years ago.
Yeah, no, you're not. Like
but on NVIDIA, bro, NVIDIA has 180 PE ratio.
No, NVIDIA has reached a point of silliness where it's like, and listen, fundamentals don't matter when there's hype and momentum, right? But they always eventually do.
Oh, and I don't want to say anything negative about NVIDIA because I
do.
But it's better produce this week again.
I do like your call though, that because earnings, because the amount of volume, it's easier to unload. It's a very easy for large, huge positions to trim. Could use earnings as that. So it'll be interesting.
Especially to do it without the hype and circumstance of doing it around a non-earnings event.
But don't worry, NVIDIA will mention AI 8,000 times in their earnings report. Like
minimum.
A minimum. I mean, and Matt, fueling, the thing, go back to the S&P real quick. Yeah. Like, hedge funds are net short. And, I have this little theory I call the mare. The mare is a Viking mythological creature that would come on your chest at night and give you bad dreams, right? So that's the mythological creature. And I have this theory that and we'll get to some of the things that could go wrong in the market here in a minute, right? Where you can get all bared up. We can have a bear party, right?
We can hint to some concern. Yeah,
we can hint to some concern. But like, I have this theory that the market can't take a true leg down as long as you have record shorts out there, as long as everyone is positioned for a huge leg down.
We're talking about things that can kind of propel the market higher, right? Even though I had a bit of a conversation on why I'm a little concerned with this potential breakout. By the way, very easily, if the cyclical areas of the market want to start participating, Mark, here, you could easily see a consistent bullish uptrend, because the hallmark nature of a bullish uptrend is quick rotations from.
Yep, you saw it in 2021. Yeah. It was textbook rotate from one area to another, to another, to another, to another.
It's those areas in the market that are overextended. They see some profit. That profit rolls into cyclical areas.
I mean, you go look at 2021. It was beautiful. It was technology. It was defensive. It was cyclicals, and everybody was taking this turn after turn.
And that's what I want to see. If you're in the bullish camp this week, okay? If you're in the bullish camp this week, what I think you want to see is, I think you want to see some profit taking in Google, Amazon, Netflix. You want to see some profit taking in NVIDIA coming through their earnings season, because you do not want to see these extended areas of the market just continually get overextended. Because if they do, the train's going to leave the station, and it's going to be just an algorithm hit parade is basically what it's going to do. And so what you want to see this week is you want to see those areas of the NASDAQ specifically that show a little bit of slowing momentum, maybe a little bit of a fade back down to give us a much better technical condition going into maybe not this week, but next week on those areas. But while we're looking at some slightly overextended nature of the tech move, the comms move specifically, maybe less so discretionary, but Amazon's a little bit overextended. As they look to see a little bit of profit taking, you want to see the cyclical areas solidify themselves. And that will give you a little bit of a better indication of what this 4,200 breakout can do. Because right now, the breadth is a concern for market participants. We know you got Apple, Amazon, Google, Meta, Microsoft, and NVIDIA, and obviously some other stocks out there as well. But we know there's stockpiling happening in those areas of the market specifically, which has created a breadth concern with just too much leadership, too much money going into the leadership at the top and leaving everything else behind. Well, we want to see that everything else get a little bit more salt.
You got to have say, I mean, because you have, I mean, and there is plenty of fuel just in the shorts. When you are the most record short in 11 years, and hedge funds are particularly short cyclical stocks, because, you know, recession, all of that stuff coming down, you short cyclicals, pretty by the playbook type stuff. There's a lot of fuel, but you got these charts right here, Matt. Materials, industrials, energy, finance. They ain't in a bull market.
Well, not one of them are. And when you look at the rankings of tactical trading, we have all basically we have tech at 25, comms at 30, and I believe discretionary at 35 right now. All three areas of the aggressive categorizations are all ranked right there in that slightly bullish, with the NASDAQ and the tech areas being a little bit more just a pure bullish type ranking right now. But there's no other sector out there at tackle trading right now, cyclical or defensive, that is ranked close to what is happening from an aggressive side of the equation. And it's it's specifically the cyclical areas. Staples had a really good trend. That trend's over. Healthcare had its moment, its day in the sun earlier a couple months back. That's over. You don't have any bullishness from a trending perspective in any area of the market outside of the aggressive. My question coming into this week, maybe not my question, but what I'm looking at this week is, again, I can't stop seeing the overextended nature of the leadership of the market. I'm not making an argument that technically Amazon and Microsoft are that technically Apple and Microsoft are overextended. It's just that Apple's coming into major resistance. I think anybody with two eyes and a beating heart would say Amazon, Google, and Netflix right now are overextended from a short-term perspective. And so there's no trades in those areas when something's overextended. You're not looking to.
I couldn't even sell a naked put on Friday on Amazon. I had a little bit of a pullback, but I'm like,
you can't sell it under support. You're so far overextended.
I mean, it's like, this is just not a good situation, right? It felt very FOMO-y.
We love selling naked puts either at support, right above support, or right under support. That's where we like selling naked puts, because we want to either have support work for us. If we're going to look to, you know, sell a naked put to own, you want to let support work for you. And if you sell a naked put to purely cash flow, which I probably assume you're doing on Amazon, is that you want to sell that naked put underneath support so that any pullback would hit support and give you that support bounce up. You don't have that right now. So when you're looking at Amazon and you're saying, I want to sell a naked put on Amazon, and again, I know for those of you listening to the podcast, you can't really see this, but just kind of go with me on it. When you're looking at Amazon and the current price of Amazon is 116, and the 20-period moving average is 108, Mark, I'm not sure I'm going to sign up for any system that says, hey, let's sell naked puts underneath the momentum 9 EMA here.
Yeah, no, that's a tough get.
That's all directional type stuff. You want to give it a little bit of room, which means you have to sell a minimum distance of at least 10% out of the money here. And you just can't get
the credit worth it.
You just can't get the premium to even come close to that. And so, Mark, if you want to sell a naked put on Amazon, you better hope I'm right on my overextended analysis where Amazon comes into a little bit of profit. Because if you wait for a pullback in Amazon, which would throw a little bit of cold water on that 4,200 breakout, but again, that's kind of what I'm assuming is going to occur here. If you wait for that pullback on Amazon, all of a sudden you can sell underneath that 20-period moving average. But because the pullback analysis has a little bit more volatility in it, typically with downward pressure in price versus upward pressure in price, volatility, even a little bit of increasing volatility with that downward expectation of price will allow you to sell that naked put for a higher premium underneath an area that you feel a heck of a lot more comfortable in. So to me, again, it's just one of those scenarios where you certainly can expect to see a little bit of profit taking occurring in these aggressive areas of the market. And while that happens, once again, coming back to my original point, I don't want to throw cold water necessarily on the trend that has developed in the NASDAQ. I think it is a wonderful, wonderful trend. My read is it's just a little bit overextended. For the market to get a little bit more bullish, for us to have the confidence,
gotta have participation,
to put the market, not just the NASDAQ, not just comms, not just discretionary, but to put the market in that bullish ranking, you gotta have participation from the cyclical specific.
Well, I gotta have participation in a lot of things. I'm gonna throw some charts out that I gotta have participation in. I gotta have participation in cyclicals. That's number one, right?
Hey,
I gotta have. Go ahead.
Well, throw out your charts and then I'll talk about it.
I gotta have participation in ARK because I don't have a bull market if ARK isn't participating in some degree. It doesn't have to outperform.
Yeah,
it's got to do something, right? I got participation in biotech, XBI.
Okay.
Right. Another bull market signal. We've seen little signals of spurts. I got to have support in the banks, right? I got to have support in the banks, especially regional banks, where I think there's a lot of upside potential, to be honest with you, on regional banks right now. Mm-hmm. They ain't all going to blow up. Janet Yellen said some of them might on Friday.
Some of them
I love it.
will.
We see more mergers coming. I mean, that's what she said on Friday.
Get away from it. Nonsense.
Yeah. You know what mergers key for? A bank blowing up and JP Morgan buying it.
Yes. Accumulation is from JP Morgan. They say mergers. They accumulate. Like what?
Like merger. What a cute. That's so cute. That's what happened, right? It was there. They were mergers.
That's why, though, Janet Yellen should not be the Treasury Secretary. And again, that's only one of the many reasons Janet Yellen should not be Treasury Secretary.
You know, it's funny. I was watching price action on Friday, and I was in my little Discord on the Vikings trading lab. And I said, price action the last 10 minutes feels like a bank blew up. Like, you know, and then, no, it was Janet Yellen speaking.
Yeah. Well, when she speaks, a bank does blow up somewhere. You just don't notice it because JP Morgan buys it.
There is not an unreason. I mean, certainly, let's sum up the bullish banter, right? Certainly, trade opportunities are probably going to be in tech for some time. Just wait for technical patterns.
Oh, heavens, yes. That moves through.
I think that's it, you know. We really, before you get, you know, like you got to have participation, right? So look for those developing. I don't care what.
That's what the importance of this week is, though. There's not a tremendous amount of earnings happening this week. Obviously, with the debt ceiling conversation, that's going to take most of the air, most of the oxygen of all conversations this week. But I think the one thing I want to see this week more than anything is I want to see those cyclical areas solidify the bottom up approach. They like, for example, you take energy, for example, Mark. Energy right now, crude oil is kind of going through a little bit of a choppy reversal right now. But what we all know is energy is sitting right at crude oil specifically. Crude oil is sitting right north of that very, very important 65 to 67 handle in crude oil.
Oh, I'm hitting USO on Monday.
Yeah, it looks pretty good from a
It's a good cash flow pattern.
And it's really hard for me to see energy not following suit on that. Now, if crude oil blows up, energy is going to blow up with it. And everything we're talking about right now is just gone, right? But again, one of the things that we are seeing is energy, one of those cyclical areas, start to slow down its momentum as it's worked a little bit lower in price. When you're looking at crude oil, for example, crude oil is going through a little bit of a double bottom, double top scenario. It's got a foundational support level right around 65 to 67. You could certainly, how many times have I said the joke, Mark? Hey, President Biden, let's stockpile those reserves right around 65, 66. There
are no reserves. Why do you keep making up things?
Because if we start buying oil at the low price, we can actually have reserves and really do that. But we have reserves. What are you talking about?
We have zero reserves.
Fort Knox and gold.
There's no reserves. Let's just get with it.
Reserves. Anyways, my point is the reason I would make that joke is because of the foundational support level around that 66. And if that continues to play out, you could definitely see energy start to find a little bit of love as it's working a little bit into the lower ends of the channel. You talked a little bit about finance, Mark, and you would like to see the regional banks, specifically the regional banks, start to solidify themselves. But Mark, after the initial catering of the financial space in March, we really haven't seen any follow through to the sell-off in the financial space itself. Regional banks, we have a little bit. They're starting to solidify themselves as well. But the financial situation is kind of in that neutral zone right now, ever since the fallout from SVB in March. And so you could see scenarios where we're talking reversal here as well. And some of those regional banks have not been too shabby. I mean,
give me KRE just as in general, because
that's where I was going next. But you've seen a couple news reports just recently on regional banks that the deposits are actually starting to increase after the initial fallout.
Yeah, I'm drawn like a moth to a flame on charts like this that aren't individual stocks, right? Individual stocks is like, oh, whatever. But when I see like,
yeah, individual stocks different.
Yeah, but when I see like these really broad areas of the market take big, huge, massive hits in the short run, I don't care if it's natural gas, regional banks, I'm like, I'm just starting to get interested, right? It's just that approach has treated me very well over 15 years.
And so you're starting to see bottoming action there. You're starting to see bottoming action in energy. There's no bottoming action in industrials because it's been the most boring space for all year long.
Done nothing for
it's like literally anytime we move it from 50, we all regretted it.
Yeah,
every coach is like, we shouldn't have moved it from 45. Just park it at 50 all year long. It's been 50. So I don't think you can ask industrials to help the cyclical argument, because industrials isn't helping. It isn't aiding, and it isn't taking away from absolutely anything right now. And so it's specifically for me, when I'm looking at this week, to really help dial in that 4,200 zone. Is because, again, just the top areas that led the market up there overextended, I can see profit taking there, is I want to see energy, number one. I want to see that work out with crude oil. Number two, I'd like you're more apt to look at the financial space than I am. But from a regional bank perspective, you'd like to see that continue its deeper retracement, maybe even form a little bit of bear stomp out analysis on the financial space deeper. And that's something I'm always going to be looking at technically. And again, finance isn't my bag. I don't really like to look at the financial space very much, but it is very important to the cyclical areas of the market in general. And anytime you have slowing momentum and trend followed by a deeper retracement, you're going to get me and Coach Frank on that bear stop analysis really quickly. And so I'd like to see that worked out. And then from a basic material perspective, we're coming into some pretty important support levels here as well. And so again, I know everybody and their dog right now thinks the cyclical areas of the market are the worst they've ever been, and everybody's jumping on the bandwagon of the AI movement, specifically in the aggressive areas of the market. But those short-term trends, they will rotate, and they will rotate from the profit-taking mentality into the bottom-up analysis. And I just think for the bull market to have for the 4,200 breakout to have some legitimacy, it cannot just be on the backs of a relatively few stocks.
It can't.
You just can't. It's got to be more broadly based. And it's this week where I'm really looking at the cyclical areas, because again, when the areas of the market that are driving the market overextended, there's not a lot of trading there, Chucky. There's not a lot of trading. Apple's not on our scouting report this week, and yet it's going through a breakout.
And plus, let's be honest, Matt, at this point, it feels like one trade. Like, do you understand what I'm saying? Whether it is Meta or Google or Amazon or Microsoft or Apple, it feels like I'm trading the same thing right now.
It's different. It's different technically because they're come from different technical conditions, but yes, it's the same theme that is driving that rotation. And a lot of those areas that are AI driven are the overextended areas. For the market to have a broad-based leg where you could have where it goes from 4,200 and doesn't just go, hey, let's drive to 4,300 in a day, come right back. No, I'm talking about something with more legitimacy. That's something that can impact the market, not just for a few days, but for a few weeks. You got to have the cyclical areas of the market to start showing a little bit more of that bullishness. And this week they did. I don't want to say this week they showed bearishness, Mark. They showed hesitation. They showed a little bit of hesitation. And if we see that momentum play out a little bit more, we could be talking about some legitimate double bottom
Matt, to be honest,
in the cyclical areas coming into next week.
I could see this way. I like the cyclical call out. You know, even you and I really didn't talk about this pre-pod, but it's kind of where my head, because I had plans on increasing cash flow exposure, which had very little to cyclicals. I could even see the market do nothing. Tech pull back just a touch, cyclicals go up a little bit, kind of counterbalance that in the formula.
You can have a scenario, Mark, where in a week and a half from now, we're talking about reversal analysis in the cyclicals plus a bullish retracement analysis in the aggressive, and we're still talking about a potential 4,200 breakout. And if we're talking about that scenario where you're going through reversal analysis in the cyclicals, where you're dealing with pullback and bullish pullback analysis in the aggressive, that's the week where you're like, open up these risk graphs and rock and roll. It's not the week when you're going through slowing momentum in cyclical and dealing with overextended natures in the aggressive, where you open up those risk graphs and you say, let's go out and party. And so again, it's just something I'm seeing out there. And because everybody out there is geeking out about the 4,200 breakout, Mark. Everybody is. Everybody's chasing the Apples and the Googles and the
bulls are dancing on bears' graves. Bears are I had to literally change my name from Mark, hello, I'm bearish, to Mark, I'm an unapologetic bear, because bears are apologizing for their existence all weekend long.
Well, they shouldn't apologize for their existence. There's bulls and bears in every aspect. But again, I'm just saying the 4,200 zone is a really, really important zone. And it's been up there for about 6-7 weeks up there testing that 4,200 zone. And to me, I could be wrong on this, but to me, I do think this is the week where you probably see cyclicals slow down a little bit. Okay. I would never call a reversal until we go through the art of the reversal, and we're only in the slowing momentum aspect of that right now. And so we're also at zones where that could occur, but I'd like to see that play out. I'm just saying, if you're waiting on that pristine bullish environment, it's not when the cyclicals are slowing momentum and the aggressives are overextended. It's when the cyclicals go through the art of the reversal while you're simultaneously dealing with the pullback analysis in the aggressive. And that is a week from now, maybe even 2 weeks from now, more so than it is in front of what right now. And so I just wanted to, because that's where my head's at right now. I think we've had a great trend in the aggressive areas of the market. I'm not calling for an end of those trends. I'm just calling for them to be slightly overextended and to be a little bit patient as they navigate that overextended nature.
Yeah. Okay. And let me close. My plans on adding bullish cash flow this week. Any pullback in tech, that's an auto hit. Pick your individual stock, picks XLC, picks TQQ. I don't care what your instrument.
QQQ, go with
pullback. Probably not going to hit it without the pullback, right? We'll wait for a base, high basing pattern.
A high base is actionable for the short-term trader, but probably for the cash flow trader, they'll probably look elsewhere.
Planning on adding cash flow to Tesla. I don't believe, because the only thing I worry about is
you're getting bullish on Tesla. I want to hear this.
It's more, I don't have very much bullish exposure because of my stance, right? I don't believe you can have a bull market without Tesla, right? I just don't think it can happen, right? And so
it's one of the leaders. There's no doubt.
And I got an actionable signal, right? Got an actionable signal on Friday. As long as that holds on Monday, I'll probably hit Tesla for some cash flow. Plan on hitting.
And I think Tesla is a week in front of like a trade.
Yeah, I mean, the nice thing about being a cash flow trader is I don't have to have as high as standards.
That's the difference. I was going to say that's the difference between the Delta Dog and the Theta.
I'm going to hit regional banks. I'm going to play that. I'm going to play regional banks because, I just can't help.
You're a deep value guy.
Yeah, I just am.
Value
Like I just think there's opportunity. And once again, if you have a real bull market,
if the banking crisis is not going to cater, isn't there value to be had?
I'm gonna make an outlandish prediction. If you have a real bull market over the next 4 or 5 months, regional banks probably are the biggest performing industry in that situation. Because
if you have a real bear market, it ain't going to be
bull market, a real bull market. I said.
Oh, okay. I was going to say a real bear market. I'd say.
Oh no, it's a different scenario. It's not. It's not for the faint of heart. And then I'm gonna hit crude oil.
A real bull market. Yeah, I think cyclicals play more catch up.
Yeah, because I just think they overperform. They've
got smoked.
Regional banks are down there, right? It's not that.
At some point, you got to come to the medium, right? So yeah, I don't know if it would be regional banks for me or if it would be energy for me, but
I'm going to hit crude oil. Like I saw rig counts go down to the lowest in 52 weeks. I just think you got a technical base there with the 200 weekly on crude oil, and you got production
unless the global economy caters, 65 is the deal on oil.
Yeah, so it just is. It just is. Let's spend 30 seconds on why the market may go nowhere, because that's kind of what it's done for 6 months.
I've kind of talked about that for 30 minutes.
Yeah, so like, I mean, no recession comes, balance, but there's still worries, right? Market goes nowhere in that scenario. Tech probably overperforms in that scenario, right? If the market goes nowhere, tech probably continues to outperform. Would you agree?
If market goes nowhere, market goes nowhere based on the same theme. But yeah, I'm not sure market goes nowhere from here.
All right, break out your bear goggles. Let's just rattle off some things that could go wrong, right? We spent a lot of time talking about things, but the market is not without things, right? Especially on a short-term basis.
Let's do this. You take 1 point from the bear, right? Why concerned, and I'll then give a different point on the bear.
All right.
And I'm not sure we'll have the same point, by the way. We might.
I don't. In fact, I know you're not going to have this one, so I'll lead off with this one. I think there is a chance of and this is not bearish other than an event day, where you could have a real massive red bar just on mechanics. Because what is happening on 0DTE, which has been overwhelmingly bullish, they put in support levels, they control. The bulls are so much better at 0DTE than bears. It's not even. I mean, just think about this, man. Thursday, debt still optimism. Let's jack up the market. Friday, talks break down. The market barely went down, right? Like they just take news headlines that are just like, they're just so much better. But in their little
describe the bull v bear for all of eternity. By the way,
I know, right? So it shouldn't be shocking that they're better at 0DTE.
2 + 2.
But one of the things that they're doing right now from a mechanic standpoint that can be backfiring a day, it doesn't lead to a bear market, but can lead to a really nasty day. They're starting to sell puts to fund their calls, Matt. Like JP Morgan and other people were noting this at the end of the week, that it wasn't just good enough to buy those calls and win there. They're now selling same day puts to fund the calls on sell-offs. Like,
they're poor boy trading.
No, they're selling puts.
They're selling puts to
zero DT puts,
call options
to buy the call option.
That's the broke boys trade.
You know, and they're doing that, and they're funding that on sell-off. So the market starts to sell off.
How aggressively bullish that is, by the way.
You know, like and so obviously that can backfire big time on any given day, right? Any given day.
I don't like that at all.
No, and you know, when I saw that, because I saw that out of JP Morgan, I saw that out of my guy Charlie McGill.
They do that because they'll do anything
because they're winning, right? Yeah. It's winning, you know.
But you're playing with fire on that one, Chucky.
And so that could blow up a day. It doesn't mean at the start of a bear market. Doesn't mean
it means think about it like this: if 0DTE has been such a bullish catalyst, if that dam breaks, you're getting broken on both sides of the ledger, which means you're
buying back puts and selling calls on a downturn
on the side, and you could have a margin situation on the put side.
Exactly.
Listen, U.S. government, while you guys are so focused on debating culture issues, realize this type of stuff shouldn't be happening in the financial world.
I mean,
we need to regulate some of this.
Matt, as soon as you heard that, because we didn't talk about that pre-production, as soon as you heard that, your brain went like, that can lead to a flash crash.
That's exactly where my head went, is flash.
Yeah, and so if we see that, it might not happen this month, might not happen. Eventually, it's going to happen.
Eventually, it'll happen. No, if you're selling puts, if you're selling calls, excuse me, if you're selling puts to fund your call options, yeah, that means you're buying your calls on margin.
And when it's one thing for an individual trader to do it, but when you got systematic funds doing it on massive levels, that is going to backfire one of these.
Mark, whenever I hear an individual trader come to me with that type of idea, I throw about as much cold water on that for them as humanly possible. And I warn them that they could blow up their account with that type of irrational behavior, and that chasing a dollar like that is just way too greedy. And there's far better ways to do this from a probable standpoint that doesn't have the ability to crash the market and break the technical conditions of the market. That I don't like that in any capacity.
Yeah, and so like if you wait,
Mark, I'm the guy that thinks. Yeah. I'm the guy that thinks we should regulate banks. I'm the guy that thinks we should regulate AI. I'm the guy who thinks we should regulate crypto. I'm the guy who thinks we should regulate this type of behavior out of the marketplace. Quite frankly, it's margin on margin, and you know exactly how I feel about margin on margin.
And it always eventually blows up, right? And I'm talking in spectacular fashion.
I'm sure these gals and guys sitting in some bank think this is something they've created, something new. You haven't created anything new. It's an old trick, and it's not worked in the past, and it's not going to work this time either. And you might think you nailed something right now until it burns you, and you're out of a job, and your bank's catering, and you have to go beg the government to bail you out. Thanks, Goldman.
Yeah, and so I saw J.P. Morgan, I saw Simon White and Bloomberg, I saw Charlie McElligott at Nomura all talk about that exact thing in the last 48 hours of the market week. So
like that,
yeah, that is like,
that's volatility we're not asking for. And
even if this market climbs up, you're going to have days and you're going to have stretches, right? And I think from a bull, you hit those stretches unless there's some genuine. Just be careful with your own margin. So that would be my bearish point number one.
Okay, now that is a concern I have in general. That wouldn't be a concern I have specifically this week. It's just a concern I have any day now. Thank you for that. But
and one last point, if you see, Matt, if you wake up one morning and you see a morning sell-off that started to go up and then just crashed, they're doing it on the morning sell-off. They're selling the puts in the morning sell-off to fund the calls, which stabilizes when it works.
And they're doing all of this just through short-term trading, like
all zero DTE.
Ridiculous. Now, can we use this information? Yeah, we'll use the information. We're just not going to sell calls to sell puts to fund our calls. That's ridiculous behavior. All right, so you got one. I'll give one. Mine's a little bit bigger picture earnings conversation. Earnings, if there's three themes that have emerged from earnings, this earnings season specifically, I'd say number one was big cap tech was just carried the market from an earnings perspective. Number two, earnings were not as bad as otherwise expected. But number three, Mark, and this is pertaining to the retail earnings side of the equation. We're for the most part beyond earnings season right now, right? I mean,
yes,
we kind of got done with it a week and a half ago. But if there's one industry that reports later than everybody else, it's the retail space and the consumer-driven space. And retail earnings has been one of those situations where there is concern coming from the retail earnings that we haven't seen in the rest of the marketplace so far this quarter. And the concern is coming from the consumer side of the equation. Most earnings so far have been lowered guidance in the quarter following maintenance of guidance for 2024. But we've gotten enough earnings out of Target, Walmart, Home Depot, the dollar stores, Under Armour, you name it out there, Foot Locker, that has now showed us that there's some legitimate concern on the consumer side of the equation. And this is something to keep an eye on over the next few months. Consumer spending reports, i.e. retail sales reports, consumer confidence economic reports, the University of Michigan Consumer Confidence Report, for example, because the consumer, Mark, you and I and other people like us, market participants, if you will, I don't want to say we've moved on from the inflationary conversation, but we've also moved on from the inflationary conversation.
Yeah, I know, right?
Right. We fully expect inflation to continue to come down, either one, through the lag of monetary policy, or two, the slowing economic environment. One of the two.
Yeah, I expect the economy to blow up, which will take care of inflation.
Which will cure inflation.
Which means I've moved on beyond inflation.
Exactly. So have I. Now, I'm not the economy blow up guy. I'm the combination of both the lag of monetary policy plus the slowing growth environment will have an impact on inflation over time, allowing the Fed to achieve their 2% number by 2025. That's what I'm on. Now, in terms of the consumer, though, Mark, the consumer isn't on that at all.
No.
The consumer is looking at this inflationary conversation, and they're staring down the barrel right now with that inflationary conversation. Most of the time, we've moved on to this because we were having this conversation for a year before the consumer. Would you agree with that, by the way?
Yep.
For about a year before the consumer, market participants were talking about inflation because we see it in the PPI report, right? We see that inflation building through the PPI report, and that inflation ends up at the consumer level. Well, Mark, if you look at the retail spending coming out of Walmart's earnings report, Target's earnings report, Home Depot's earnings report, the consumer is not spending.
Oh, listen to talk about the disaster of Foot Locker on Friday.
Items at all. They're not spending on anything, a big picture at all. They are meat and potatoes right now. They are food on the table, and that's about it right now. And that's a concern for the retail side of the equation.
And Matt, it was a stark difference from last quarterly of the same companies, right? Mm-hmm. Like the same companies.
Well, and you mentioned Foot Locker, right? But
ain't nobody buying shoes.
Yeah, they don't have food to sell. They have a problem. You need to get some Snickers in that store right now, Foot Locker. But the reality, Mark, is up until Foot Locker, the concern that I just talked about was specifically to this quarter coming up, the third quarter coming up. Walmart lowers guidance for the third quarter. Target lowers guidance for the third quarter. You saw it across the board in the retail space, lower guidance for the third quarter. Up until Foot Locker, who says no, we're gonna lower it for all of 2024 as well. And so that concern on the consumer, Mark, if there's one thing that I would,
and Matt, it was the market was like, holy shit, we got to price in this right now. And you saw Foot Locker down 30%,
and they did. And they priced it immediately because, again, everything was being held up in the retail space a little bit, given the fact that there was, okay, yeah, we get it. Walmart, Target, you're concerned for the quarter. Walmart, you're concerned for the quarter. But nobody else was concerned for 2024 up until you saw that guidance coming out of Foot Locker. And then it's like, oh, maybe Walmart, Target, and everybody else isn't as, because, again, what I'm talking about here, Walmart and Target and Home Depot specifically are not selling discretionary items nearly as much as they want to, number one, because most consumers are still staring down the barrel of the inflationary conversation. And even if the market has moved on from inflation, the American consumer has not, because they're still dealing with it every single day. You're dealing with it. I'm dealing with it. Everybody listening to this is dealing with it. Do you enjoy going to the grocery store these days, Chucky? I know I don't.
Matt, it is all my spending habits, right? Now, I'm a pretty conservative spending my money by nature, right? Okay. But as I've gotten older and had less need to do that, but I'm like, I've gotten back to, like, I feel like I'm in my 20s again, where I'm like having to watch a budget if I want to continually.
Well, yeah, because if you go to a fast food joint right now to buy something for your daughter, it costs $20 for a lunch for lunch for your daughter at McDonald's these days. It's absolutely
no. And Matt, if you're a believer in the Big Bear thesis, which I am, yeah, right, that the interest rates will crack the economy, especially in an inflationary environment. A necessary component of that is the consumer has to crack hard. They account to what, 65% of the GDP?
A healthy majority.
Yeah, and so you can't have a big bear thesis unless you crack the consumer.
Was the foundation of the entire bull run from 2010 through 2020. It was the argument of the strength of the consumer. You never doubted it. You never questioned it. You knew the American consumer was going to do what the American consumer did, and that's buy shit. And right now, their only stuff they're buying is eggs, bread, milk.
Yeah, and Matt, let me give you some other things concerning this as well.
Let me finish my point real quick, though, Chucky.
Well, Matt, the consumers aren't going to have any more money if you finish your point. You got to finish it quick.
That's true. So my point is this. If there's one of the arguments for the bull thesis, like you said, you're a believer in the big bear thesis.
I am a big believer.
It's going to crack the economy and the market's going to cater. Well, one of the arguments for the bull thesis is the strength of the labor market, and that is the foundation of the bull thesis is the strength of the labor market because of the American consumer is so strong. But if the American consumer is now showing a little bit of weakness in that discretionary spending, that's going to have a little bit of an impact down the road as well, because you're not getting a soft landing without the American consumer.
No chance.
It's not happening. The American consumer has to come through here. And so there was a little bit of concern. Okay. And so one of the concerns I have just this week that I'd like to see it confirmed outside of, Under Armour or Foot Locker. I'd like to see it from Best Buy, for example, or from an NVIDIA, for example. I know NVIDIA is reporting they're a tech high flyer. They're going to say AI 45,000 times, but I'd like to see it come through this week. Or do we see more concern coming into the consumer? And does that build a little bit from an economic perspective? So that's one of the concerns I have is
and just from a historical perspective, to highlight the old .com podcast, I wonder if we're still in 2000, right? Fed pause, not a whole lot of concerns, but they're starting to build, right?
Mm-hmm.
I wonder if we're still in 2000 from the big bear thesis, which would make 2024 2001. 2001 Space Odyssey for the bear dreams.
Your bearish heart.
All right, let me give you another bear.
I give you a little bit. I gave you a little inkling of some bearishness, and you just took it. I
ran into .com.
This is the end of the world. .com 2001.
Yeah. Listen, I'm going to give you a short term.
Give a bear an inch and look what happens.
I'll let you maybe do another big bear thesis. I'm going to just stick with the debt ceiling. I will believe that these two sides can come to an amicable agreement without a market reaction when I see it. And maybe that is the stock market selling off strong for 3 or 4 days. Maybe that's the bond market, yields going up and bonds collapsing. I don't know. I cannot see these two sides just amicably without some pressure from some external force, just getting along and making a deal. I just can't see it. Man,
I haven't been getting along so far.
Maybe it'll happen. It'll happen. But as long as that, and we don't have to wait very much.
Political world as long as I have, you shouldn't be surprised by this back and forth in the debt ceiling conversations. This is negotiating tactics 101. I'm not surprised by last week at all. I'm not surprised by the positivity of it at the very beginning of the week, and I'm not surprised with the Democrats on the far left trying to yell at Biden for any potential deal, and Republicans on the far right yelling at McCarthy for any potential deal, and then both sides going back to their caucuses to try to sell the semblance of a negotiated deal. I've long held the belief, Mark. In fact, I was taught this by law professors in law school way back in the day, that if all parties are a little bit unhappy about a deal, it's probably a pretty decent deal out there. And so last week, good news coming out from McCarthy and Biden. By the end of the week, they had walked away from any potential talks. I've never seen, actually I have, I've been around politics a while. But it's a little bit rare to be like, we're done with talks. And then 30 minutes later, they're talking again. Nope, and I've seen it out of both sides. we're done with talks. We're calling off negotiations. And then an hour later, they're negotiating and talking again. Like, this is absolutely ridiculous. I think so many times we interpret these big picture political events through the lens of CNN and Fox News. And the only thing we're getting on CNN, MSNBC, and Fox News are talking heads or talking points that are led by their parties that are targeted to the respective bases of both political parties, which I'm not sure is the actual truth of the negotiated stance of what Biden and McCarthy are actually trying to accomplish here. And so, to me, I'm not surprised that there's a little bit of yin and yang here at all. I fully expect a deal to be done. I'm just not sure
where a deal has to happen or the whole system breaks down.
And everybody knows
that. So we all know that. I just think it's going to need a nudge. I just think it's going to need a nudge.
Well, we talked about this last week about the potential of the parties to, because of the contentiousness between the parties, it's probably not going to be a clean debt ceiling bill. And you're probably going to have a negotiation here. And in that negotiation, there's going to be some positives and there's going to be some negatives. Right now, where we stand is this on the debt ceiling conversation. McCarthy and Biden are scheduled to speak tomorrow one-on-one. I wouldn't exactly say that's negative for the heads of both parties to sit down across from each other in a negotiated stance and find some semblance of.
Well, I'm going to give you a prediction. They come out and they say, nope, we hate each other. We're never negotiating. The market will be down 0.1%. And if they say, yeah, that was a pretty good meeting, the market will be up 2%.
That's yes, you're explaining the general market mechanics to the marketplace right now. The Bears get so upset that they just don't. It's not a fair game. It's not a fair game.
It's not a fair game.
Not a fair game, and you can cry about it, or you can just join the bull team over time. So you get to choose that.
You do get to choose.
You get a
free agency for now.
It is for now. Mark's a free agent. He's looking which team he wants to join this week. I fully expect a deal to be had here, Mark. I just feel like you're going to see some political maneuvering on both sides to try to get a deal, and the market could have some moments of volatility this week when we play the will they, won't they game. And I certainly expect us to play a little bit of will they, won't they game. And that's also kind of baked into my conversation earlier today on the podcast where I'm like, hey, listen, we got some hesitation coming into that 4,200 breakout. Some of that hesitation is based on the debt ceiling conversations.
All right, give me another bear point. My one should be
debt ceiling. Debt ceiling is the only bear point. The consumer. Obviously, we can geek out on bearish analysis. I can talk to you about big picture stuff, but pertaining to this specific week, no, I think it's seeing Best Buy, seeing some of the consumer retail earnings this week to see if we're more like the Walmart of the world or are we more like the Foot Lockers from the consumer perspective. And then number two would be the debt ceiling conversation. It's hard for me to see a clean breakout occur when the politicians are still kind of wrangling over position on the debt ceiling conversation. We're still trying to figure out who they're going to blame and who they're going to give credit for on a deal that's going to happen. And so as the politicians play that will they, won't they game, you typically will see market volatility kind of match that as well. And so I'm not sure we get a deal this week, Mark. We probably get a deal more like a deadline deal here coming into closer to the first. So I think it's more than anything, I just think it's more of a hesitation than bearish analysis. But I do have some hesitation based on the debt ceiling.
Yeah, and the biggest one, because I gave a couple of short terms, mine is still another short term one for me is market breadth. Until I see things, small caps clinging at the lows and energy clinging at local lows, and PayPal destroyed and your average stock a wasteland, it is hard for me to do anything other than tactically play things, right? Like to be like, I'm going to go tactically play Tesla. I'm going to go tactically play this, right? Because every time you've had this type of participation gap, you've had a market incident in the short term.
Well, let's see if we can get a pullback in the big cap areas of the market and get some stabilization in the cyclical areas, and that will help the breadth conversation.
Well, to be honest with you, even though that would result in a maybe market down slightly this week, it would
result in market down slightly.
That would be a positive
better development for the future.
It would be a better development for the future because you're building bases on beat up areas more. Because you keep holding support, there's only one direction to go. And so you give a week of that, tech comes down a little bit, provides a better entry. That could provide a good week next week, especially if you get debt ceiling party.
I honestly think this week specifically is a development week. I do. I think this week is the development week going into next week being the action week.
Any thoughts on gold before we close up a podcast?
No, it's a covered call environment, and it certainly could be some bouts of volatility this week, along with the debt ceiling conversation. But I think gold's in a covered call environment right now, and it's just a matter of waiting for some stabilization in that area of the market. I'm always going to respect short-term breaks of support, even if it's on an instrument I love.
I mean, yields just skyrocketed this week. A lot of pressures.
Dollars.
Bonds had their worst weekend like forever.
Well, dollar had its best weekend for a long.
And equities are just like, we don't care because equities live in la la land.
Well, they're not. They're getting carried here, but it is a little surprising to see the strength of the dollar and not even sniff 4,100 with the dollar breaking out. Like that was a little, that can't continue, by the way. You cannot continue to have a bull market and a bull dollar.
I mean, you have like February, you had a pullback on yields, dollar strength that sent, you got a little pullback in equities because of that. It's setting up to do that again if these trajectories on yields and the dollar continue. Because they're sniffing out higher for longer. And goodness gracious, first time we've mentioned Fed speakers all podcasts, but they're out there. Success. They're trying to out hawk each other this week.
I don't care.
They are trying to out hawk each other. So
they're the boy who cried wolf.
Nobody believes them.
They'll be right every now. They'll be right on something. They'll come out and say they're right. No, you've been wrong for years now. They've lost credibility, in my opinion, and like Mark, everybody on Wall Street was geeking out over what Powell was going to talk about on Friday. I watched Powell talk on Friday. It was a snooze fest of nothingness between him and Bernanke, just trying to, out credit one another about their personal impact on the marketplace. I was disgusted by even spending 30 minutes watching that nonsense. They've lost credibility in my estimation.
A couple weeks ago, I made a call. Natural gas next move up. Bitcoin next move down. Bitcoin.
Actually.
Natural gas next move up. Respect better, but that's not. I want to make another call, Matt. Make another call. I like regional banks as potentially the biggest. And this is a caveat because you have to have A equals B. Yeah. I like regional banks being the best performing industry if this market has a continued breakout and holds above 4,300 in the next.
Basically, what you're saying is if I'm right on my analysis of the aggressive cooling off a little bit, giving, and again, we haven't seen that. We still see aggressive pumping and
stabilization to even modest participation in cyclicals. Tech's doing techie things.
I'd call out if we're right on the stabilization argument, I would pick energy over finance, but I would do that most of the time. That's not.
And in the environment, I like small caps over S&P, Qs over everything, just because it's easy from cash flow. NASDAQ. But I like regional banks under this scenario. Obviously carries risk because if the big bear makes its ugly head known,
we haven't talked cyclicals for weeks and weeks and weeks. Not in the house.
This ended up being a cyclical podcast.
Right? Not in anything. We haven't talked about the Russell other than just say, hey, it isn't very good. I think there could be scenarios coming up over the next 2 weeks where we're talking about stabilization in the cyclical areas of the market. So again, there is an important economic report on that. You get the preliminary GDP report this week, but We'll have a lot to say about that in the halftime report. And if you love the podcast, we do this with visuals all the time in the halftime report every day. You should come over to our Tackle Trading YouTube channel and subscribe as we go live every day at 12:30 Eastern Standard Time, called the Tackle Trading Halftime Report. And with that said, Mark, I'll send it to you for some final thoughts.
Yeah, no, listen, it's a tricky market for me, Matt, and everyone, like, because I'm bearish, right? But I don't want to lose any money either, right? I'm not going to be a stupid hedge fund that shorts the market as it melts.
You're bearish, not in position.
Yes, no, I'm bearish I'm bearish in the sense that I don't almost.
Your bias is bearish.
Yes, my bias is bearish, right? And I'm trying to, but it's a tricky market. Like, when I was preparing for my Sunday night prep class, which I do in conjunction with the podcast, I'm like, this market could melt up. I could see it. If recession is delayed again, right? Cyclicals participate, AI theme. This market could melt up. The market could do nothing, but the market could have some short-term jolts, right? Yeah. Whether it's zero DTE or repricing Fed hikes or whatever, right? And so it's hard to come up with a plan that covers all bases, right? But I think you just continue for your own portfolio, work through that, right? Don't be too greedy on any of the equations, right? Try to make sensible individual decisions. Do I think adding Tesla is a sensible decision, independent of everything? If it is, and you're not at like max exposure, right? Like, just work through the things one at a time, right? Don't overcomplicate things is my main point in a tricky environment, right? This isn't the easiest environment you will ever find, right? And money spends the same, Matt. A dollar made in an easy market spends the same as a dollar made in a hard market.
Listen, 2022 is far more difficult than this year. This year's been, we've had themes dominate the market. We're getting back to rotationary models. And yeah, it's the most difficult part of navigating this market is navigating the opinions of the marketplace.
So listen, check us out on the halftime report all week. Email us at team@tackletrading if you need anything at all. We appreciate y'all. We appreciate this all. So we'll be back with 529. And I'm going to short McDonald's. I don't care if it's symbolic. I don't care if it's one share.
You're not shorting McDonald's.
I might short a share symbolically and just say, this is my share of McDonald's I'm shorting.
Later, everybody. Have an absolutely great week. Hang out with us in the halftime report every day. And if you love the podcast, a nice little 5-star review on iTunes goes a long way for those Apple algorithms. So love you guys. Hope you have an absolutely great week. And if you need anything from Tackle Trading, you can always email us at team@tackletrading. And if you need us for any reason for your trading or educational needs, you can always hit us up at our Tackle Trading Discord as well. With that said, we're out.